what I'm going to do is start you out with a little bit of Dilbert. I have lots of numbers this morning, and Dilbert says, well, if you don't know any numbers, you just make them up. Well, how many studies say that? Well, 87, of course. A word from my sponsors. Kaufman and Knowles is responsible for me being able to come around and do these kinds of things, and I appreciate it. But this slide is really the theme of what I'm talking about this morning. What motivates the housing market? Look at this for a moment. The blue is housing permits, and the red is the annual change in total employment here in Hampton Roads. Now, what you're seeing there is that they track each other very closely. And the direction of causation, folks, that you guys want to come out here so you can see? The direction of causation is from jobs to housing, not the other way around. Now, there's a little bit of joint causation, but the relevant point here is that the housing market is really not going to improve in Hampton Roads or hardly any other place until the economy improves, until people have jobs. People without jobs can't buy houses. Okay? So, not anymore. So, I'm going to talk about three things. Defense spending is about 45% of the regional economy. So that's the big driver, and I want to talk about that. Then I'm going to talk about the port. That's about 10% of the local economy. So those two are over half the deal here within the region. And then I'm going to talk about the prospect of price inflation. We don't have much control over that here. The decisions are made nationally and internationally, but they're pretty important to what will happen. But anyway, look at this slide. This shows the percentage of our gross regional product that's due to defense spending. You can see at the beginning of the last decade, we were down to about 34%. Now we're up to 45 or 46%. We're more dependent on defense spending now than ever. All the talk about diversifying our economy, for the most part, hasn't really been accurate. We're less diversified now than we've been for a long, long time. So defense spending really calls the tune and is critically important to what we do. And incidentally, if you want copies of these slides, I can provide those for you, no problem. We have those already there. But let's talk about defense spending. DRFCON, of course, is getting lots of attention, and it appears now that we're only going to lose about 1/2 of the number of employees there. DRFCON is spending about $560 million in the region. It appears now that our hit is going to be somewhere in the range of $200 to $250 million. I say somewhere in the range of because we don't know exactly who's going to lose their job and who isn't and what they're being paid. Here's one of the reasons. These are all the commands that are inside DRFCON. Now, if you can figure out from that exactly where the cuts are coming, more power to you, but I can't, and most people are unable to do that. And so we'll have to sort of wait and see, but the best guess is this is going to cost us maybe $250 million within the region. What's most likely to stay? Well, obviously modeling and simulation, and then the kinds of things that can be moved to the Naval Base Norfolk that can be consolidated. Those are the things that are most likely to remain. But I'd like to convince you this morning that it isn't DRFCON and things like that that are the major pressure or risk for defense spending in the region. Rather, it's an overall trend towards less defense spending overall. This is from the Financial Times and looks at defense spending over the past decade. That gold stuff there is overseas contingency operations, which is a euphemism for Iraq, Afghanistan, Libya, things like that. Okay, this is what the Financial Times thinks is going to happen over the next few years. Look how much smaller that gold gets. Essentially, somewhat, they're making a political judgment here about what will play in 2012. But also, they're recognizing that defense spending is likely to taper off because of deficits and deficit reduction and things of that sort. Now, if that is the way things occur, folks, all of us in this region are going to hurt. Not only will there be fewer houses sold, there will be fewer pizzas purchased and automobiles sold and so forth. That kind of defense spending means stagnant growth, economically speaking, here in the region. Okay? These are the biggest defense contractors nationally. And you can see Northrop Grumman, now Huntington Ingalls, number 4 there at $23 billion a year. Here are the biggest ones regionally. And you can see Northrop Grumman's our biggest regional contractor, $3.58 billion a year. But look at the list of the rest of these. If you do business with these people, or your customers do business with them, these are the kinds of people who are most likely to get hurt. These are the people who are most likely, as contractors, going to feel the bad effects of a decline in defense spending. But there are other things that you should bear in mind with respect to defense spending. And again, the reason I'm spending so much time on this is 45% of the pie. It's so important. Rapidly rising costs of major weapon systems, they're going to talk about that, personnel costs, and then the overall federal budgetary problems. Look at this picture. This is kind of an interesting one because it shows the cost of major weapon systems. But this graph is a little bit different. This is a log scale. That means that this is 10 times as high as that, and this is 10 times as high as that. Now, if I didn't do that way, the graph would go up like this, and it would go completely off. Now, what that says is that if you're looking like at the cost of a P-51 Mustang and comparing that to an F-22, the cost has gone up dramatically, but even more than this graph shows because this is 10 times. So it's going up like that. Well, what does that mean? It means that the Defense Department can't possibly buy as many units of these things as it used to. The cost of major ships, airplanes, and all that sort of stuff is simply going through the ceiling. That means in the future that even if Oceana, nothing happens to that at all, they can't afford to put as many planes there. They're simply too expensive. They can't buy as many nuclear submarines. They can't buy as many aircraft carriers. Indeed, major weapon systems costs are going up through the ceiling, and that means that there are going to be fewer of those kinds of things, and that's going to impact us here in the region. But then there's the matter of compensation. Now, we have a voluntary military, so we have to attract and retain. Military compensation has gone up rather rapidly over the last decade. In fact, military compensation of uniformed personnel has gone up over this last decade 2.4 times as fast as the private sector. And if we're talking about civilian military employees, their compensation went up over the last decade 80% faster than the private sector average. Well, mine is not to quarrel about this, but if you're going to have a voluntary military, you have to do this. You have to attract and retain. But what I'm going to suggest is that isn't going to continue. And all the budgetary recommendations we see now are talking about much, much smaller increases in compensation. Once again, folks, that means that there are going to be people out there who don't have as much money to spend as they might have had in the past. This is a graph which is already a little bit out of date because we're now above $120 billion a year. We're spending then about $10 million a month in Afghanistan. That translates to about $300 million a day. Whether or not you think that's a good idea, I'm simply going to say I don't think that's going to continue. I don't think probably that's a winning political plank in 2012 in somebody's political platform. So I would expect to see that taper off. I'm not sure we'll declare a victory and lead, but somehow or another I don't think that's likely to continue. And if that's the case, we'll feel it here. Maybe not as much as some other areas because Afghanistan is not primarily a Navy operation, but we'll feel it nonetheless. But we have some peculiar challenges here. It seems likely that we'll lose at least one aircraft carrier group to Florida and maybe another to the Pacific over the next decade. Now, each of these is worth about $900 million a year when you count all the personnel and the ships and the support and so forth. Every time we lose an aircraft carrier group or one goes out to sea, that cuts 0.1% off our growth rate every month. So that's 1.2% off our growth rate if we lose one completely. That translates to about $900 million a year. To put this in perspective, that's about twice as important as the closing of the Ford Motor truck plant. So those aircraft carrier task groups are very, very important, and the unfortunate truth is we're likely to lose 2 over the next decade. 1 for sure, and my guess would be 2. Second, there's the possibility that the commitment in Oceania will get smaller. If we don't have that other landing field somewhere, that's going to be very problematic for us. But on top of that, as I pointed out, the planes are just getting so expensive that I doubt that they can continue to do what they're doing. Right now, there are roughly 11,000 employees at Oceania, and I'd be surprised if 5-10 years from now there were that many. There are some positives out there, though. Middle Creek, among other things, is pretty heavily committed to special forces things and special operations. I would think that that would be something that's going to expand over time. As I pointed out, I think there's the possibility of centralizing tasks at Navy Base Norfolk, and maybe that African command will come in there. And then we have a real specialization in the region on modeling and simulation, and I think that's going to become more and more important because the DoD simply can't afford to buy as many people as it did in the past. So you get into this question sort of, what will future military needs be like? What kind of a military will we need? And one of the questions, of course, with respect to aircraft carriers is whether they will be, in some sense, obsolete. We know they can project power, but can they be defended? The Virginian Pilot had an article several months ago showing how aircraft carrier groups could defend themselves using lasers. Well, you don't have to be Albert Einstein to figure out that the lasers can come the other direction. And the real question is, can you defend large capital ships like that? Well, I don't know the answer to that, but it's an interesting question. I've already talked about things becoming expensive. Are we going to be talking in the future about battles that are increasingly involving drones and robots and so forth, and so large ships and things like that won't simply be as important? Well, I don't know the answer to that, but I can tell you there's a good deal of uncertainty out there. Special forces, electronic warfare. Will future warfare be on, attacking things like our financial system or Google or maybe even our water supply, as opposed to conventional military battles? I mean, if I'm a weak country out there, a terrorist, I don't want to get on the battlefield with the United States of America. We have the most powerful military in the history of the world, and nothing else is close. So you're going to choose other things, aren't you? Things that you can do that would inflict harm on us, but don't necessarily involve conventional things. Well, Secretary Gates has recommended really all of these things, 78 plus 34 plus 35 plus 29 billion of cuts. I doubt whether all of these things are going to occur, but President Obama has made it very clear that these kinds of things in general have his support, and I think across the political spectrum you're likely to see some tapering off of the support for defense spending. Secretary Gates says he wants to cut 10% out of DoD overhead, and he's questioned directly the need for as many aircraft carrier groups. He just says, we don't need as many of those. Okay? Now, that metaphor at the bottom is an important one. You probably have heard this in terms of cruise ships, like the Queen Elizabeth or something. It takes a long, long time for it to change directions. Well, I think that's what we're seeing in defense spending now. It's going to take a long time, maybe most of a decade, to see the changes both in the mix of defense spending but also in terms of the amount. But I think that process is starting now. Let's switch gears and talk about the port. These are the 4 critical factors here. I'm going to come back to these in a moment, but transportation links, the deep draft port we have, APM terminal, and then shipping firms versus distributors as a strategy. But this is what the recession did to cargo tonnage at the Port of Virginia. It really knocked a hole in that, and we've come back, but we're still substantially below the levels we were. And again, the port is about 10% of the regional economy. But these data show that in some sense we lost a portion of our competitive position over the past couple of years. Look at the far right there, 2007 to 2010. Savannah grew 8.55%, okay? But we declined 9%. In fact, everybody virtually was declining except Savannah on the East Coast. Savannah pursued kind of an interesting strategy. First of all, they had lots of state incentives from the state of Georgia. And lots of sort of good things happening in terms of support there, but they went after distributors, the Walmarts and Targets and people like that of the world, whereas our strategy in Hampton Roads was to focus more on shipping companies like APM, Maersk, Hanjin, and so forth, and we did okay. We didn't contract as much as the rest of the nation did, but Savannah did much better. So they used to be the #3 port on the East Coast. Now they're #2, and frankly, right now they're pulling away from us a little bit. Okay? So that's an important thing to keep in mind. This gold here is Hampton Roads. We're 6.2% of all the container traffic in the United States. That sort of purple thing, that's Savannah, and those two big ones on the right are Los Angeles and Long Beach. That's where most of the stuff coming in from Asia, from the PRC and places like that comes in. Okay. Let's go back to those things that I talked about before. Transportation links. You no doubt read about and have heard about the Heartland Corridor. This goes off into the Midwest. It now enables us to double stack those TEUs and to get to a place like Chicago a day quicker. It cuts about 250 miles off the distance. This is really good stuff for the region. We can now go to places in the Midwest much more efficiently and at lower cost than we ever could before. That's a major plus for us. Deep draft port. Our major advantage overall is that the port of Hampton Roads is deep draft. There's really nothing else like it on the East Coast. We can handle ships that are much larger, deeper draft than anybody else on the East Coast. And so right now we're admirably situated because in 2014, the redone Panama Canal will open, and it's going to be able to handle much bigger ships. I mean, much, much bigger ships. And right now, we're about the only place those ships can go. Now, Savannah and New York, New Jersey, which are #2 and #1 respectively on the East Coast, are going to have to change what they're doing. They're going to have to scour out their ports, and there's going to have to be some dredging done there. In New York, New Jersey case, any of you who are from that area know of the Bayonne Bridge? Well, you got to go under that. And so they either have to tear this down and build a new one, or they have to raise it up, or they have to do a lot of dredging. It's going to be very expensive. Well, they're probably going to do it, but it's going to be very costly to them. However, New York and Savannah do have a couple of advantages locationally. Savannah will always be closer to the Panama Canal than we will. And New York, New Jersey will always be closer to Northern Europe than we are. But right now, we're deep draft, and we can handle vessels that they can't. The APM terminal in Portsmouth, I shorthand it by saying it's very efficient. Indeed, this may be the most efficient port on the East Coast, maybe even in the United States in terms of handling cargo, getting it out of ships and onto railroad cars or however it's going to leave the port. It's a really fine operation. And so this is an advantage for us. #4, I've already covered that. We probably need to place a little bit more emphasis on distributors. We have maybe 80 large warehouse distributorships within the region, but in Savannah they have like 220. So they have lots more of that sort of thing than we do. Connected to all of this, though, of course, is transportation, isn't it? We have to be able to get product in and out of the port. The Heartland Corridor is very helpful, but we still really haven't solved what I'll call the truck problem. And I'm very sensitive to that at Old Dominion University because a lot of those trucks go right by. But we have to be able to move product in and out. And so whether it's building new bridges and tunnels or whatever, that has to be an important part of our future if we're going to remain competitive as a port. Let's now again segue and shift gears and talk about inflation. This is more of a macroeconomic thing. And it's not something we really can control, but it definitely is going to influence the housing market. Let me summarize what I'm going to say with three statements. First of all, inflation right now, as measured by the CPI, really isn't very high. We're talking about 2.5% or something, and by historical standards, that's not much. Lots of people have been predicting inflation, but it hasn't quite really occurred, although there are signs I'm going to show you that it's coming. But number two, the Fed did 2 stages of quantitative easing. That's another way of saying they went out and plugged lots of money into the system by buying U.S. government bonds and assets and spoiled mortgages and lots of things. And I'm going to show you how much of that they did in a moment. But the Fed put all this liquidity out there. In fact, the New York Times commented that the Fed was dropping money out of helicopters. Well, I didn't see any of that, but the point is that the Fed really increased liquidity. But third thing is there really are signs that there's inflation on the horizon. And I want to talk about those now a little bit. But here's the CPI. That blue line is the core CPI. That eliminates food and energy. Now you might say, well, why do you do that? Because I've got to pay those costs too. And of course, that's absolutely correct. The reason the Fed does that, though, is food and energy prices go up and down. And so when they're thinking about what the appropriate monetary policy should be and what they should take in the way of actions, they don't want to be deceived by the fact that there was a freeze in Florida that pushed up orange juice prices or something like that. But the red is the actual CPI. And you can see that prices actually declined during the great worldwide recession. Now we're up in the range of about 2.6 or 2.7%. Okay? The trends have reversed. For most of the last decade, prices were gradually trending downward. We sort of conquered inflation over most of the last decade, but now you can see we're sort of headed the other direction. And the real question is, well, how much of this are we going to see? Well, which prices are increasing? Well, at the very top there you see oil, gasoline, things like that, and somewhere in here there is housing. It's rental housing. I'll see if I can find that. Yeah, rent of primary residence, going up only modestly. And I mention that because in the CPI, almost 1/4 of the weight in the CPI relates to housing. But it isn't the price of new houses, it is the rental value of houses that they use in the CPI. Okay? It's the rental value. And you can see that's beginning to go up. Some of the things that are going down, car and truck rentals, new vehicles, leased cars, some things like that. So some prices going up, some prices going down. But here's something to keep your eyes on. What are the things that we have to buy to produce things? Well, we're talking about raw materials, we're talking about oil, we're talking about things that we need to buy in order to maintain our economic activity and produce things. And the really relevant thing I want to point out here is these lines are trending upwards, aren't they? The things that we have to buy to produce things, inputs, everything from food to oil to whatever, those prices are trending upward. You can see everything from steel to food to whatever, okay? And this, of course, is the price of oil, which as of the end of last month was $112 a barrel. And, of course, that translates to gasoline. And anybody who's filled their tank lately knows that. But all of this relates to the possibility that the CPI is going to continue to trend upward. But some prices are going down. I stuck this in. It's about a year or so out of date. But medical prices, of course, are going up. I think we all know that. But like cell phones, prices are going down. So when we talk about the CPI, some prices are going up, some prices are going down. And it depends who you are as to whether your personal CPI is going up or down. If you're not buying some of the things that are going really up in price, it doesn't hurt you. On the other hand, if you're doing a lot of commuting, buying a lot of gasoline, and now food prices are going up, your personal CPI might be much higher than 2.6 or 2.7. I mentioned before that housing is about 1/4 of the CPI. See this? The horizontal distance here is the size or the importance of the housing in the CPI. And because they're looking at the rental value of housing, not going up very much, but you can see that what's been going up, of course, is motor oil and fuel and things like that. But this is kind of an interesting slide because it says what's been going up the most and how much do these things count in the CPI. One of our major suppliers, of course, is the PRC, the People's Republic of China. What's happening to prices there? Well, the answer is they're going up, and they're going up faster there than they're going up here. And it can't be very long before that translates to higher prices at the Walmart and everywhere where we're buying things that are produced in China. And for the most part, most of the same kinds of things are happening around Asia. In fact, in several other Asian countries, the rates of price inflation are much higher. We're going to feel that inside the United States. And prices are also rising in Europe. Not terribly fast, but again, look at the trend. Prices are going up, whereas previously they were going down. Now, I said the Fed, this is sort of a complicated graph, but you can incidentally find this in the Wall Street Journal. They're very nice about this. But this is a picture of what was true on September 17, 2008, which is just about when the major problems started, and that's when the Fed started to pump money into the economy. They had $979 billion of assets then. And without going into great detail here, this is how the Fed's assets have gone up since then. How did that happen? Well, they ran the printing press and bought assets. They bought everything from mortgages to U.S. government bonds to a variety of kinds of assets. Okay? And you can see here, if you can read that very well, that this big blue stuff right here, these are mortgage-backed securities. That's some of that stuff that didn't smell very good, and the Fed bought them in order to keep the financial system and maybe even the housing market from collapsing completely. Now, remember that number, 979? Now, this is what's true on the 13th of April of this month, 2.6 trillion. So the Fed just about tripled its asset portfolio. Now, they own all these assets, some of which aren't worth much. But the relevant point is they pumped all this money out into the system. And that's going to result in price inflation unless the Fed is very clever about withdrawing that. Okay? It's just sort of supply and demand analysis. You put all that money out there, you're going to have price inflation unless they're very clever and very astute about how they begin to withdraw that money. Okay? And the question is, can they do that without sort of plunging us into another recession? Not clear, but that's something they need to do. But here's what the markets say. This is the difference between the 10-year bond rate and the 10-year TIPS rate. Now, the TIPS rate is a Treasury inflation-protected security. That's the bond where you get a certain rate plus whatever the CPI is, so you're protected from inflation. Okay? So if you look at the difference between an ordinary bond rate and the TIPS rate, that tells you what the market's forecast is for inflation. And what this says right now is that right now, over the next 10 years, the market is forecasting inflation of about 2.5%. But look at the trend. If we continue to do what we're doing now in terms of running large deficits, and I can sort of go right down the line, that's going to get wider and wider. It's going to drive up interest rates. That means mortgage rates will rise, and it's going to be more expensive to buy a house. Meanwhile, this is what's happening to the value of the dollar. Now, one of the reasons this is occurring is that things like gold and oil are priced in dollars. And so if there are lots more dollars out there, and each dollar is worth less with supply and demand, then the price of gold and the price of oil have to go up. But anyway, each dollar is worth lots less in terms of other currencies than it used to be. There is a good side to this, though, and that's that second dot. Probably this is going to mean that more foreigners are going to be in the market to buy assets, including housing and commercial properties and so forth. Why so? Because they can buy lots more. I'll tell you a quick story. Several years ago, I was on the board of the Wheeled Pitt Steel Company. We eventually sold out to the Russians because the dollar was falling in value, and the Russians came and said, we want to buy this thing because it's really not going to cost us very much because the value of the dollar has fallen so much. Well, it turns out they made a bad deal because about 1 month after they purchased this property, the Wheeled Pitt Steel Company, things went to hell in 2008, and they haven't produced a ton of steel since then. They really got stung. But the dynamic I'm talking about is a very important one. There are going to be lots of people, almost like the Japanese did in Hawaii 20 years ago, who are going to have lots of money to spend, and our prices are going to appear to be very low to them. So I would suspect that especially in resort-related properties and things like that within the region, you're going to see more and more foreign buyers who are coming in. And at first, Doc, a little bit of price inflation might be pretty good for the housing market, actually. Sort of rev things up and maybe get rid of some of that inventory. But rising interest rates, which I'm suggesting may be on the horizon, aren't going to be good for you folks and what is it you want to do. Let me stop talking and very quickly see if you got any questions you want to drill me with before the...
What do you see the impact of China's increasing use of coal on the ports in here? Do you see more exports?
Yeah, we are the biggest coal port in the United States, and nobody else is close. We export more coal from Hampton Roads than all the rest of the coal ports combined. China and India are really demanding more and more coal. We may be exporting environmental problems to them, but it's very profitable right now. And so it's a good deal for us. That's one of the reasons why I would suspect our port is going to do pretty well because, you know, that Lambert's Point coal terminal, it's going full blast right now. Natural gas right now is inexpensive and is a really more efficient fuel in many ways than coal, but it's a matter of being able to convert energy sources to natural gas, and also some of the things that the Chinese want to use energy for, they can't use natural gas for. But here in the United States, I would expect to see not just more homes, but automobiles and trucks and everything else run on natural gas in the future because we've discovered lots of new sources and the price has gone down, and it's the most efficient fuel relatively right now. You want to say it again now?
Effectively, QE2 ends June 30th of this year. So I was asking, do you expect an increase in inflation and in that respect, mortgage rates as well, since it's only a few months away?
Yeah, the Fed has been keeping mortgage rates and interest rates and everything artificially low. And that's probably going to come to an end. I would expect to see, as a consequence, yes, rising mortgage rates, and you know, it's virtually inevitable because lots of things have been distorted by what the Fed has been doing, and as mortgage rates rise and interest rates rise, that's not going to be good for the housing market, I'm sorry to say. And I think the Fed is going to ease away from what it's been doing.
To talk about the credit rating and again, the vote coming up on the debt ceiling, what do you really see as that, and is that, what's going to happen in that regard?
Well, I think that eventually there will be a grand bargain struck in Washington that's going to involve cuts in spending and some tax increases. And the best sign that it's probably a doable thing is that both sides won't like it. But we can't continue to run $1 trillion deficits year after year after year. You can go over and look at what's happening in Greece and Portugal and Spain now and say, we're only a couple of years away from that if we continue our current behavior. Eventually I think there will be a deal done, and maybe the gang of six that you've probably read about, the 3 Republicans, 3 Democrats, but it isn't going to be something that lots of the partisans on each side like, but it's probably going to be necessary. Thank you very much.